Well, thanks for having us. This is a great news story, and I couldn't be more excited to be here with Colin Meadows. Colin Meadows has founded O15. I run Invesco, and let me give a little bit of background. Colin and I have worked together since 1999 when he was a young McKinsey analyst. He didn't have gray hair, nor did I.
I was 12 at the time.
Life has changed. And when I joined Invesco in 2005, I said, I'm going to need some help here. My first phone call was to Colin Meadows, and so we've worked together for a long time in Invesco. There's nothing that Colin hadn't been involved in. And we are here today from what was a tragic event, and it was the murder of George Floyd. And when that happened, Colin reached out to me and said, we've got to say something to our organization. And it just opened up a very different dialogue for us as an organization, and we sent the communication. What I would tell you is it is my 20 years plus of being a CEO, it was the most single responded email that I've ever sent from everywhere in the world. And from that, it really impacted many people. This is actually a good outcome from a horrible thing. But Colin, why don't you pass on your thoughts?
Sure. So I guess it was in March of 21, Marty, when I invited you to lunch and said, hey, I want to talk to you about something. Now, as Marty mentioned, we've known each other since 1999. I've worked together. I worked for Marty since 2006. And, I knew what I was going to say. I was like, I'm going to be leaving to do something else. But I must say, I saw this piece on quiet quitting, that this was not an option for me as a senior executive at Invesco. I had some trepidation about telling Marty what I wanted to do. But it was really in that post-George Floyd environment when a couple of ideas that me and my partners had been kicking around for a while really came to fruition. And the concept that we had is, as an investor, you're always looking for underinvested, undercapitalized opportunities. And one that had kind of been on our minds for a long time was companies that were led by or managed by women or people of color. They've historically had trouble getting access to capital, but they continue to be formed and are growing. And it always perplexed us why more investment firms weren't going after it. And it was really in that post-George Floyd moment when a number of asset owners and asset managers said, you know what, we're going to do something about this, and start putting some wood behind the arrow of impact investing that really got myself and Ken and Brian, my two partners, to say, look, now it feels like the time to do something here. A few stats in terms of the investable opportunity. By our estimates, there are more than 20,000 businesses in the U.S. with more than 10 million in revenue that are led by women or people of color. So our view is that's a big enough investable universe to matter. When you talk to those entrepreneurs and you ask them what your biggest business challenges are, what inevitably comes back is access to capital, right? And particularly access to credit. And so for us, it stands to reason, post-financial crisis, a lot of banks pulled back from community banking and either left an absolute gap in the market, or they were replaced with investment firms like the one we're trying to build. But all too often, minority entrepreneurs don't know to call XYZ Capital Partners in Chicago or New York. And so our view was, if we could build something right here in Atlanta, Georgia, in the heart of the most diverse region in the country, we could do two things. We could do well, have some impact, do good, have some impact. We could also do well. We could deliver investment returns for our LPs that were consistent with any other strategy that they might have. And so we really founded the firm with that purpose.
And I'll never forget that March lunch. I was like, don't want this to happen. But really, though, it's a talented person like Colin, on a mission, and what you just heard is what Colin communicated to me, this massive need and the thought process behind how you can make a difference for people, but also generate the returns that are very attractive to institutional investors. And it's that marriage that is so powerful. And so maybe you've doing two things: raising money right now. We'll come back to that, but also you've talked to some entrepreneurs, and my sense, quite frankly, not just the ability that your team has to invest, but you in particular, your background to help bring management teams along that probably many of them are early, not fully developed in all those skills as many entrepreneurs are. Can maybe give a couple stories of some of the engagements you've had so far.
Sure. So we officially launched 015 in June of this year. So we're kind of 3 months in business. And one of the things you're always trying to prove when you have a new investment strategy is it going to work? And the proof of whether it's working is can you create deal flow, right? So I know there's some venture folks in this audience, and deal flow is the lifeblood of an investment firm. We have seen more than 50 deals since we launched the firm just 3 months ago, which really speaks to, frankly, the demand in the marketplace for what we're doing. 2/3 here in the Southeast, all of them, most of them hitting kind of our impact strategies. And so we're talking to entrepreneurs. So give you a couple examples. A fintech based in Louisiana that's focused in the ed tech space. They sell software to school districts, particularly low and moderate income school districts, that helps kids improve preparation for state tests, ACTs, et cetera. It's a great business. It's profitable, several $1 million of EBITDA. They're looking to grow.
Yeah.
And so, we're talking to firms like ourselves about providing that growth capital as well. Talking to lots of firms in the healthcare space, talking to an interventional radiology practice out in Houston, Texas, that's got 3 locations and provides a procedure that particularly impacts people of color, particularly women of color. They're looking to expand from 3 locations to 6 locations. And so those are a couple of examples of the types of organizations we're talking to. And to the person at these firms, they're all experts at what they do,
Absolutely.
right?
Yeah.
So radiology practice, it's full of doctors, right? This ed tech firm is full of tech entrepreneurs who have a deep spike in education. Their sole focus is on growing their business and offering their product to their customers. But as they look to grow, they're now introduced to this whole new world of finance and that they don't know that much about.
Right.
And so, part of the dialogue that we have with those entrepreneurs early on is just articulating to them, here are some financing options for you. Here's how to think about the marketplace. Here's how to think about equity capital, some of the implications for dilution. Here's how to think about credit, non-dilutive capital as an option for you, a hybrid mix of both. And so I think that conversation is quite helpful to them early on. And I'd say the place where we probably spend the most time is frankly getting their financials in a form that we can underwrite.
Right.
So one of the things that we are adamant about is we think that there is no daylight between investing for impact and investing for return. We actually think those things are reinforcing. So when we're underwriting a transaction, we're underwriting from a financial standpoint in the first instance. We're also underwriting from an impact standpoint, but we don't give any quarter on the financial returns. So we need a set of financials that make sense, that we can use to come up with a proposal for them. And oftentimes, entrepreneurs, these are low and middle market companies, so they've got, call it $5 billion of EBITDA up to $10 million. It's a good business, but they don't have their financials just there. And so we do spend some time there with them on that. And as a credit manager, we tend not to take board seats other than in certain occasions, but we can continue to be a counselor to these businesses and these entrepreneurs as they grow.
So let's stay on that for 1 minute, and I'll come back to the market environment we might be in right now. The next stage, all of us that have met entrepreneurs, and let's take this subject matter expertise, passionate about what they've done. They've driven the business to an area where it's already successful. It's that next stage. What about conversations around bandwidth and sort of management talent in some of these conversations?
It's a huge topic, Marty.
Yeah.
So particularly in the current environment, access to talent, it actually seems like it's the scarcest resource, maybe even more scarce than capital, particularly in spaces like, so our verticals are healthcare, education, and business services. And so healthcare in particular is just challenged in terms of access to talent. And so, we talk to them about the importance of getting talent. We leverage our networks to be helpful to them so they can access talent. There's some consulting firms and other staffing organizations that we partner with to be able to provide that. But it's a huge topic, and one of the kind of, as I mentioned, the scarce resources that they're looking for.
So how I think about this, listening to Colin, it's just not capital, but it's also helping put these businesses in a position to be successful. And again, back to Colin's long business career, this is a very natural skill for him. So I think that's wonderful. I think it's, the combination of those things are really going to improve the likelihood of success for these businesses.
We think so. The other thing I would mention is we did pick the verticals that we're focused on quite intentionally. They both have the benefit of having particular impact in these communities. They also are fairly resilient from a recession standpoint. We're obviously going through a cycle as we speak right now, but at the end of the day, healthcare is kind of a need, and you need it when you need it, regardless of the environment. Similarly with education, and so my partners have a deep expertise, particularly in the healthcare space, and so I think that has been a value add and enables us to have those conversations with entrepreneurs above and beyond, here's some financing, right? Here's how we can help you staff your business, grow your business, et cetera, and we think it's going to start to pay off.
That's great. So now let's talk about the environment we're in. So if these businesses were challenged getting financial support during what were great markets, it's not so true right now. So I would imagine if in a difficult business cycle, some of the more traditional lenders, it's even going to get tighter, right? So it would have been a worse situation for these businesses. So it's got to be creating further opportunity, I suspect, for you.
It does. So look, we're in a rising rate environment. Can't turn on the news without someone talking about the Fed and where rates are getting to and are going to. It's interesting, as an investment manager, you ended up having kind of two minds about it, right?
Yes,
so,
right.
We're an investor and we have returns to deliver to our LPs, and we're a credit fund, floating rate credit fund, which means as rates rise, our cost of capital goes up, the cost of capital to our investors, and our returns, frankly, get better. The challenge is, as you mentioned, as rates go up, banks tend to pull back. Right. We're already seeing that in the marketplace today. So, certainly post-financial crisis, banks have put a lot of restrictions in terms of how they will lend. It is actually very hard if you're a small business person today in the lower middle market to get bank financing unless you've got huge amount of assets or equipment to lend against. And so we do think that specialty finance firms like ourselves can play a role there. So we are seeing increased deal flow because frankly there's less competition. But it also makes you sharper as an organization. So when rates are going up to where they're getting to, entrepreneurs have to think long and hard about taking any form of capital. So one of the challenges with equity versus debt capital is on the equity side, it's kind of hard to see what you're paying, right? So someone is taking a stake in your firm, and at the end of the day, if your firm is super successful, that stake costs you a lot of money.
Right, exactly.
So, but as a debt provider, that we print right on the term sheet, right? This is going to cost you SOFR plus 800 basis points or whatever it is. So you see it, but at the end of the day, credit is actually also in most cases cheaper than equity. And so educating entrepreneurs on that, but making sure that they can make a really informed decision and that the capital is both needed and will be put to good use is particularly relevant in this kind of an environment.
Well, look, no doubt going to be great returns for your investor. No doubt you're going to help a lot of businesses that not just from your capital, but from your expertise. Maybe let's turn to a different conversation. So you're out in the marketplace. You're talking to all different types of potential investors, and maybe we've had these conversations, you've talked to some fascinating, so where are you in that process and what kind of feedback have you had, if you don't mind?
So for everyone out there that's trying to raise money for your fund or your business, I understand. Raising money is really hard. It's particularly challenging in an environment like the one we're in. And I was telling Marty earlier, one of the benefits if there's any benefit from the pandemic, is everyone moved to kind of Zoom meetings. So, as a fundraiser, you can get lots of meetings these days. We actually find you can get lots of meetings because it's very easy for someone to click on a Zoom or a Teams and spend some time with you versus having them fly out, et cetera. But it does, in some cases, lower the commitment of the person on the other side of the screen just because it's so easy. And so you have to navigate that process. I will say, we're 3 months into it, and one thing I should mention is Invesco is investing in our fund. So thank you, Marty. Invesco is an anchor investor in our fund, and that certainly opens up lots of doors for us. I'd say so far so good, though.
Yeah.
So the story that we tell resonates, right? So being able to say, look, we think there's a market opportunity here that is real and frankly hasn't been kind of fully penetrated. We've got a team that has done this for their entire career. The entire team is investors, right? So we have, Brian and Ken, my partners, have combined 50 plus years of credit experience, so they know what they're doing. We're here based in the Southeast. It's a national fund, but we're based here in Georgia, again, the most diverse region in the country, where, as far as we know, we are the only impact credit fund in Atlanta, right? Which is shocking to think about, but we're the only one. We just started. So that story resonates with investors. And then I will say, post George Floyd, this idea about impact investing, being able to combine investing for return and investing for good, impact, et cetera, has really come to the forefront. And a lot of allocators, particularly in the endowment and foundation space, want to see it work. And so I'd say we're in a number of good conversations. Good news for us is we're heading towards a first close on the fund sometime early in Q1, so kind of January-ish, and I'm confident that we'll get there and raise the rest of the fund over the course of the year. So it's not easy. Right. I was talking to one firm, a much larger firm than us, that raised several $1 billion, and they said they did 1,200 meetings over the course of something like 8 or 9 months. Right. Again, most through the screen, but
that's a lot of meetings.
It's a lot of meetings, even for an established firm. So you end up making lots of new friends. My LinkedIn is 5 times larger than it was 6 months ago, for sure.
I suspect it is. Actually, why don't you talk about the name of the firm? Because again, it's actually, it really tells a very good story, quite frankly, from my perspective.
Absolutely. So the name of our firm is O15 Capital Partners, and we often get the question, what does O15 mean? As many of you run companies and are founders, you do have those conversations with your partners early on. What should we call this thing? I wanted to call it Meadows Capital Partners, but my partners said no. But in all seriousness, we wanted something that was meaningful to us. And so what O15 refers to is Special Field Order 15, which was issued right at the end of the Civil War, just 200 miles from here in Savannah, Georgia, and famously promised 40 acres on a mule to former slaves. So at that time in the Civil War, there were something like 40,000 black refugees that were following the Union Army throughout the Southeast, and they said, well, we've got to figure out something to do with these people and get them to a place where they can be successful. And so the 40 acres and a mule, there was no mule, but there was 40 acres, was all along the coast from South Carolina through Georgia and Florida, and it was meant for folks to be able to farm that land. Now, as things go, the field order was issued in January of 1865. War ended. Lincoln was killed, Johnson became president. He rescinded the order in the fall of 1865. And so no one got any of the 40 acres, and again, there was no mule. But for us, it stands for this idea that to fully participate in capitalism, you need capital. 150 years ago, land was a primary source of capital, but the concept is still true today. And so, and it really speaks to the mission of what we're trying to accomplish here at O15 Capital Partners.
And for what it's worth, I remember we had this conversation, is this a moment or a movement? And all the conversations I have with clients and consultants, it's a movement, right? And it's locking, capital to do good and impact investing. And you might talk about some of the conversation you had with a couple of the consultants, because it does feel different this time, quite frankly.
It does. So look, I'm 51 years old. I have been in this industry for pretty much half my life, and I can remember other incidents and things that have happened. And so you always have that question of, is this time different? Is there going to be is this just a limited reaction to something that happened, or is there going to have kind of real traction and teeth to it? And frankly, 2.5 years ago, I was probably a little bit of a skeptic as to how much traction this would have. It absolutely, though, does feel 2 years in that this is much more movement than moment. And I think you're seeing it at various levels, both in the endowment and foundation world, which I think have historically been focused on impact investing. So these are large families, family offices. They can kind of do what they want with their money. What surprised us is the level of traction and interest we're getting from public pension plans. So these are state plans, in some cases corporate plans, that they frankly don't have to do anything. But they are reaching out to their consultants and saying, look, we think that there's some elements here that can make sense from an investment standpoint, non-concessionary investing, and we'd like to be part of it. In fact, there's actually been a couple of public pensions that have reached out to us. We heard what you guys are doing. We'd like to have a conversation. Now, those are long conversations. You got to have lots of them to kind of get there. But we've been heartened in terms of the reaction to what we're getting. I'll also say I do think that having larger institutions, in particular, start to invest behind these strategies has helped us as well. So, in the last couple of years, folks may have seen kind of large firms raising impact funds that are, $1.5 billion. Like, that is only helpful to us because it proves the concept to the marketplace that this is a real investing strategy. If we had any criticism with what they're doing is, when you raise $1.5 billion, you're deploying checks in the $50 million range, and quite frankly, there's not nearly as many opportunities for entrepreneurs of color who need a $50 million check versus those who need a $10 to $15 million check, and that's why we focus on a smaller strategy and focus on the lower middle market.
But again, to me, what makes it's so clear to me, and you hit where you're focusing, it's going to make that impact. You're really still dealing with startup businesses, really, and it's to get to the next level. And when you want to help, there's nothing like creating financial support, which creates wealth, which creates self-esteem, and that's enduring, right? And I think that's really something, from my perspective, what you're doing is going to be really successful and check all the boxes that you want checked.
Thank you. So look, we do think that capital formation is frankly part of kind of social justice in this country. This is a capitalist society, and it's primarily a business, and so we do think being able to get deserving entrepreneurs access to capital that helps them grow their businesses, serve more clients, build wealth for themselves is a self-reinforcing thing, and we think that that's a positive for society as a whole. Now, again, we're managing a fund, and we're here to deliver investment returns for our investors, but we also think that these knock-on effects are quite helpful too. Yeah,
look, I couldn't agree more. So what are we missing? What are we not talking about that we should?
I think we can talk about our kids or something like that. I think
they're all getting old too. So,
no, you hit on a lot of the high points, Marty. I will say, I do. So we talked to lots of LPs, and your name comes up a lot in terms of being a supporter for entrepreneurship here in Atlanta, and the work that you're doing with us, with Engage, and the Chamber of Commerce, et cetera, is like super positive, and so it's great to see. I'm not surprised. I've known you for 30 years, but it's really helpful.
Well, again, this is a great event, doing great things, and I couldn't be more proud of what Colin and his team is doing. They will be very successful, and I'd hurry up and write your check. Get it in. The fund's closing. You heard it. So with that, thank you very much, and look forward to seeing everybody around.
All right. Thanks, guys.